Hello, everybody. This is Christian Thwaites of Brian Janikowski. Welcome to our monthly update. I'm joined by Rita Lee.
Hello, good afternoon, everyone.
And we're going to take you through our market update as well as our some of our outlook for 2020. We did put our 2020 outlook in a little bit more detail, both in the quarterly statements that have just gone out and in the blog just before the holidays. So if I don't cover them all here, there's plenty of places where you can find them. So let's just dig right in. So we've had a very good January so far. S&P is up 3% after a scorching 2019, where it was up 29%. Emerging markets been a little bit behind that, up 2.8%. I believe, Rita, that's mostly China and Korea, which have done well.
Well, primarily after the trade truce, which we'll talk about.
The trade truce, yes. So finally, that was a bit of an overhang for both those countries, of course. But let's come back, especially on China. International markets, other than emerging markets, a little bit flat. Again, they had a good 2019, not as good as the S&P, but a better fourth quarter than the S&P. And they've taken a little bit of a break. And then the all-important 10-year Treasury is lower today, 1.7%. It's really been moving between about 1.65, 1.7, and 1.8 on the upside. It doesn't seem to be able to get out of its 200-day trading average, which is a good thing because the 10-year Treasury is the ultimate bellwether investment, and so we're looking at that very, very closely. So let's just start off with the market. Can we go to the market value one? Do I have that one up there? No, it's actually the first one that we had.
This is the first.
That's the first one?
Mm-hmm.
Okay, that's the first one. This one's showing the just how low. There we go. That's the one I wanted. So here's just how big the S&P has got. We're up to about $25 trillion on the S&P. And I put this measure up. There's lots of ways to measure the stock market. None of them are infallible. Lots of them have false signals. Really, it's a question of putting a lot of them together and kind of seeing what situations we are. But this is one. I picked this one because it's actually used by Warren Buffett, and it's been quoted quite a bit before. But all it does is just take the market value of the S&P and divide it by the nominal value of the GDP. So you can see that we're certainly climbed up. That's that orange line, 1.15 times. So it's been higher. It was higher before the crash. Not that we want to bring that back to memory, but it's a kind of at a cyclical peak right now. So that's one measure where the market seems to be a bit overvalued, and it's very difficult right now to find any single metric which will tell you the market is undervalued unless you really torture the data until it screams at you. But this is one where I'm not particularly concerned about this one. I think it's a rather strange way. A lot of people use it, but the market value of the S&P 500 is the market value of a lot of large companies. A lot of whom get their sales from overseas, whereas the US GDP does not include sales of companies overseas. So it's just an idea of are we ahead of ourselves too much or not? And I think that I use this one as a placeholder form as every metric on the market right now, which is that we're not too far ahead of ourselves. The next one just shows how low yields are. So there's the 10-year Treasury, a benchmark bond, down about 1.79%, and the dividend yield on the S&P, which is about 1.9%. So you sort of add those together to get an idea of what sort of returns we can get from capital markets. And obviously, we're at very low levels, 3.7%. It's been that low a couple of times before. When interest rates were very low in 2012 and 2016, interest rates are still low, and it's come down quite a bit. But you've got to remember also that inflation is very low. So let's look at the next slide. Actually, before we go to that, I just want to show one of the discrepancies. I put this chart in the blog last week, but it's an interesting description of how the stock market is not the economy. So a lot of our clients have said, well, how come the stock market is doing well? The economy is slowing down. It's done so much better than corporate earnings as a whole in the general economy, and things just shouldn't be that good. Well, here's Here's an example why. So on this, we just picked out JP Morgan, but it could be any one of about 150 S&P companies. And we took the reported earnings of the company, which we indexed from back to about 150 in 2011, and now about 257, so up about 150%. And then we took earnings per share, which is the blue line, which is up well over twice that. And the simple answer is because the bottom line shows that JP Morgan's been buying its shares back like crazy. It's reduced its share count by about 20%. 10% of that's the last couple of years. So you get this discrepancy where corporate earnings as reported are not doing terribly well. They might be up, 5-6%, but company earnings per share can be up way higher of that. And this is how they do it. They essentially change the denominator by reducing the number of share counts. So that's why we've seen such a good performance of the stock market, where companies have been buying their shares back at a rate of about 2 to 3% a year. Okay, next one. Thank you. So let's kind of dive into the economy right now. This was a big indicator. Our basic thesis is the economy is just slowing down. It's come from this rate, which you talked about before, of well over 3% when the tax cuts came through at the beginning of 2017. And then it's just been 2018, it's just been kind of slowing ever since. And going back to its probably sustainable long-term rate of about 2%. And then it's really been held up by the consumer. And here's a very good indicator of what the consumer's doing. It's the blue bar line at the top. It's showing roughly that total retail sales are about up 0.3% month on month. So multiply that 12 by 12 to get a rough number for what it is on the 12 side. And it's really just not doing anything spectacular. You can see that big spike that it had about 9-10 months ago when people felt a little bit more flush after the first full year of tax cuts came through. But since then, retail sales, an indicator of consumer confidence, have come off quite a bit, but not enough to put the economy into the recession. We're going to keep on saying that this economy is slowing. It's slowing in a lot of critical areas, but it's probably not going to go into recession. There's no kind of early recession indicators that we see of. So that's retail sales. The next one is a couple of slides on inflation. So the one to look at here is the difference between the headline inflation and the core inflation. As we mentioned in our blog, neither of these inflation measures are followed by the Fed. They follow another one, which we'll talk about in a minute. But if you're feeling that you kind of go around your daily business that headline inflation is relatively strong, you're not mistaken. It's about 2.3%. But the core CPI, which takes out the gasoline and energy and some other prices, is quite a bit less than that, 2.25%. And some of that is reflecting lower prices in the shelter index up at the top, but also reflecting higher gas prices. But so our point here is that inflation is non-existent from a retail point of view, but it's much lower from a policy point of view. And so the next one. And this is another one that we like to look at. It's a great slide. I love this title, Atlanta Fed Sticky Price. So what they do is they look at various components of the inflation, some which move very quickly and some which move very slowly. So the examples at one end is that your gas prices move very quickly. There's a squeeze on refining or spot prices go up. Your local Exxon or Shell station is going to reflect those prices pretty quickly. In fact, on average, they change the prices about every 2 weeks. And then there's other things where it takes a long time to change the prices because it's just a lot of work. So if for a restaurant to reprint its menus, it's a bit of a pain. So they wait until prices settle down and they change their prices, maybe once or twice a year. And then at the other extreme, if you've ever been to a coin-operated car wash recently, you probably noticed that they haven't changed their prices in a very long time because they have to reprogram the coin-operated slot machines. Same with wash and dryer machines. So these are some areas where they might only change the prices about 3 or 4 times once every 3 or 4 years. So again, we got 2 examples here where inflation is kind of edging up a little bit, but the flexible price inflation is extremely muted. And our last slide on inflation just shows the various different inflation measures. These are all the inflation measures you ever need to know. But the important ones are the bottom ones in the blue, which is the personal consumption inflation measures. That's the ones the Fed measure, and it's the core one, ex-food and energy, and the regular one. And you can see they're trailing the headline CPI by about 75 basis points. The remarkable point about this, inflation has been pretty much on a level, straight level, PCE, for the last 20 years. And it's very difficult to see inflation breaking out. There's a lot of people who'd like to see it break out. There's a lot of people, urging investors to buy gold because they think it's going to break out. But really, it's very, very difficult to see that there's any kind of meaningful, breakout in inflation at all. So that's our kind of view that inflation will stay pretty muted. Okay, next one. And this is one of the reasons why. Here's the earnings, hourly earnings. Now, hourly earnings in the blue line are up about 3%, but hourly earnings, the top one, $10.96, is pretty flat. It looks like it's grown a bit, but if you look at the slide on the left-hand side, it's the scale. It's gone from $10.40 to $10.96. So 50 cents in real terms, in about 6 years. And then the black line is the year-over-year change in real terms. So, earnings are barely keeping up with inflation. And that's the major story. And this is hourly earnings, which is one level. And the other thing you look at is weekly earnings. So hourly earnings might go up, but the number of hours that people work can go down. And in fact, they have. So hourly earnings are even a little bit more disappointing. In fact, the next slide shows this. It's the last slide here, so if you're getting a bit blurry on the slides, I apologize. But you can see that bottom one is 0.1, and that's real average weekly earnings of private employees. And there you go, down 0.1%. So wages just aren't simply moving. There is some margin compression that companies have, but it's not by increasing wages. It might be increasing some benefits, but it's more of it's a margin squeeze on the supply side due to the trade problems. So inflation is really not an issue, and that's one of our big theses where we don't see that kind of breaking out, even as we're seeing a slower economy. And just briefly on the economy, look, I kind of divide into what's doing really well, what's doing kind of meh, okay, and what's doing not well. And so what's doing really well is housing. That's a typical lagging indicator. As interest rates go down, which they did in 2019, housing then begins to pick up. Housing starts spike. There was a weird, very big number in last month. Don't think that's sustainable. But anyway, they're going from about 1.3 million starts annualized to about 1.6, but they're like 1.4 million, I think, in the underlying trade. That's going really well. Retail and the consumer are kind of going okay, which we've already discussed. And the areas which are pretty weak is anything to do with trade, whether it's import or exports. You can pretty much thank the trade policy for that. Anything to do with investment, especially big gross capital investment or non-residential fixed investment, business investment. So those have been the kind of weaker sides of the economy. But as we said earlier, we kind of expect the economy to come into about a 2% range. So very quickly on US stocks, we're kind of okay where we are. The stocks are not cheap by any historical standards, but nor are they overly expensive. We see bonds continuing to do what they're doing primarily because the Fed's very much on hold. Overseas, things take a slightly different picture, and there's certainly some catch up both with Europe and emerging markets. And Rita, maybe you'd like to.
Yeah, so Europe is finally turning the corner with some of the uncertainties dealt away. Brexit finally coming to some type of certainty. Trade wars also with the U.S. with China, with Europe, with Germany, with France, all coming to some type of clarity. And some of the European elections have been gone. So part of it is catching up, as Christian said. Part of it is Europe finally, having some type of monetary stimulus as well as potentially fiscal stimulus. So we're watching keenly on that front. On the emerging market side, a lot of people have been saying that emerging markets next year should be much stronger. We agree that it should be stronger now that some of the clarity has come. But there are certain things that we are still concerned about. China has a number of, internal issues, despite having phase one signed. We think that there will be other types of trade tensions just persisting. And China also have a lot of inflation last year, as opposed to us having next to none. So that wage growth also has been an issue within China. So all these things will be a little bit of headwinds to them. And the fact with the phase one trade deal, China agrees to buy more manufacturing goods, agricultural goods, and all kinds of things from the US, which means they will be buying less from their neighboring countries. And those will be Vietnam, those will be Indonesia, Malaysia, Taiwan, even Brazil. So that all those you can hear are emerging markets. So some things will come out from them, from those countries, and come to the US if this deal will materialize.
I think that's a really important point, because I mean, trade wars usually end up being a zero-sum game. So if China's committed to buying however many billions they've committed to with agricultural products, more industrial products, they're going to stop buying from somewhere else. And as we said, Brazil's going to be really
Brazil is going to be, and some of them, the other countries providing the electronics probably will be hurt. Some of the other countries providing the machinery, parts of it probably will be hurt.
And I think we've also discussed internally about these supply chains, where I think a lot of companies, US companies, have started to move those from China to elsewhere, and we'll see that emerge in the next year or two.
Right. Some of them have moved already, and I think it's hard, as we've talked about, it's hard to move back and forth. So once you've built a plant over there, you will continue to produce over there. So we see China probably having a bit more clarity this year, but a lot of headwinds.
Good. Well, thank you very much. So we'll just put our big three points out there. Mention the Fed. We really hope the Fed is really not much of a headline grabber this year. They don't want to be, and I think they made it very clear that they want to ease until they see some big numbers which will push them to either cutting further, unlikely, although that's what the common consensus is, or hiking, which they probably won't do prior to the election. Stocks. We did mention quickly that earnings are down in the S&P, primarily because of the big weighting of energy sectors stocks. But we expect that to end in 2020, which will actually be a better year for overall stock earnings. And then better on the emerging markets and international, which have just been under such a cloud. They did have a good rebound, a terrible 2018, much better 2019, although not much as well as the S&P, but strong double-digit returns. And they're probably going to be relatively better. So we're sitting in a pretty good place.
Yeah. So given this outlook, some of the tactical asset allocation changes that we're making will include slightly, having a slight overweight in the U.S. primarily, because we still think that we have the stronger economy. We are happy with where we are in terms of international and emerging markets. We are at the lower end of our range, but we're happy where we are. On international?
Very much so, yeah.
Yes. With bonds, we're not expecting another 12% year, right, Christian?
Definitely not.
But we still favor high quality, for sure. We are also looking into our treasury holdings, making modest changes there. We still like our short end holding, the floaters, as well as the 2-year treasury. We think that's a really good value compared to, 5-year, even 10-year. It's pretty flat. The yield curve has been pretty flat. What else have I missed?
We've got a couple of questions up here. One, which is, are we adjusting our asset allocation given the potential EU and EM catch up? We've got a pretty good weighting in EU and international. In an all stock portfolio, it's probably 18, 20%.
Right,
Which
18%
kind
in
of,
all
it's lower than a lot of people, but that's been right for most of the last 5 years. There isn't, I think the EM is pretty well priced at this point, and you've got a very heavy weighting in China, and China still, manipulates its stock market in a way that makes it very unpredictable at times. And the EU is cheap, but it's kind of cheap for a reason. So we don't really want to see that increase. I think 18, 20% seems to be a perfectly reasonable weighting given the outlooks. And are there any industries where wage growth is doing much better or worse than others? Probably not. I think what you're seeing is more non-wage benefits growth. People are trading in higher healthcare costs, which the employers are picking up than they are. That's
exactly what's happening.
Yeah, I mean, I don't know if someone said, don't let your kids grow up to be. I'm not quite sure the answers anymore, but it's I think tech has seen a squeeze, and banking and finance has been going on for a number of years, and I could maybe think of some minor industries where wages are strong, and that probably just reflects a shortage in skilled labor, probably short term. Yeah. So no.
If you want to move to Iowa, or where oil fields are being dug.
Yeah. No. Anyway, so wage growth isn't really moving very much. Good. So I don't know if there are any. We can open the lines, so anybody has a question, the lines are open now. Just feel free to speak. I'll stay quiet for a second. Are the lines open at this point? Okay, good. What impact do you expect the elections to have on the markets and the economy? That's always a tricky one. That's one of these unknowns where markets do very, very badly with elections and trying to guess what the ramifications are. I remember when the last election came up, we did a lot of analysis of what it meant for a Trump victory versus a Clinton one, and we got some of it right, but it's very difficult to get that right. I think the simple answer is if the Democrats seem to be pulling ahead and they stick with this with the healthcare, then that would probably continue to impact healthcare stocks. But that's really the story in 2019. I think some of them have recovered from that and probably, thinking if that does happen, then they can probably live with it. I mean, the obvious ones, if Democrats do that, then defense might go down a bit, but healthcare, as I said, might have an impact. But on the trade side, really don't see any changes. Both parties seem to be more willing to enter into a kind of managed trade era. They're just going about it different ways. So so it'd be interesting to see what the election does, and there'll be lots of ups and downs as one pulls ahead of the other and then back again. Normally, an election year is not a great year in the market, but not great can mean flat.
Yeah, and having more certainty, I think, will help with investments. The CapEx have been lagging for a while, a couple of years already. So eventually, some certainty will be able to promote some of that.
Yeah. Good. Well, thank you very much, everybody. We're going to put this up on the web as a recording, a podcast. Do please check us out in wherever you get your podcasts from, Apple. So Brown Janikowski will come right up, and where you can get our recordings there. And again, any kind of questions, feel free to call us on anything or check out our website, bnjadvisors.com. There's plenty of information there on the investment side and questions you have. Okay, and now I'm going to read the disclosure. So here's the disclosure coming. Disclosure is coming right now. I'm going to start the disclosure right now. Here's the disclosure. Please note the information provided in this presentation is for general information purposes only. It should not be considered individualized recommendation or personalized investment advice. Investment strategy discussed in this presentation may not be suitable for everyone. Each investor needs to review an investment strategy of his or her own particular situation before making an investment decision. Or expression of opinions are subject to change without notice in reaction to shifting markets or economic conditions. Past performance, no guarantee of future results. The opinions presented cannot be viewed as an indicator of future performance.